So Forex, Forex. So Forex is a short for foreign exchange. The FOR is means for foreign, and EX means exchange. Nti yɛka Forex bebrebe a FOR no ɛyɛ foreign, EX no ɛyɛ exchange. Nti ɛyɛ foreign exchange, right? That is the meaning of Forex. Exchanging one country's currency for another. Nti yɛmfa ne sɛ Ghana sɛ mepɛ sɛ mekɔ US a mehia ɔmo dollar no na mede me cedis na exchange ɔmo dollar. So that is the meaning of Forex. We are exchanging currencies. And I say me too can call South African rand or something. Then I will exchange my cedis with their money. So that is basically what Forex is. Yeah. So an example is exchanging dollar for euro. So if I have dollar and I want to change it to euro, I just do the exchange. So that is what Forex means. Foreign exchange. This is say I take for Forex I say. All right. So Forex price movement. Because a Forex price movement a coin bet sooner price of currencies no a movie. Those currency price. We are dealing with the price of every country's currency, the value of every country's currency. So they move, they are not static, they change. That's why even in Ghana here, I see this, the rate can be 10 today, tomorrow you wake up and it is 12, 13, like that. It fluctuates, it changes. Then those movements, what are the main what drives the of price movement? So primary driving force behind Forex price movement of supply and demand. Into your supply and demand, I mean, say, oh yeah, economics supply, yeah, supply and demand. I say, if I say to idea market, na say omo providing your money the brand, they call them suppliers. And I ain't in your money free providing your money referring demanders. Into suppliers those who provide the goods, and demanders those who go for the goods. Into Forex market yɛmfa say mikita euro and mikita dollar. Na mikita dollar na me de ba beji cedis because me demand for cedis dollar no price ebeba from na cedis price na koso ma me invest na me ni say mikita cedis na me pese me ko US na me hia omo dollar no nti me de me cedis no be kwa kwaje dollar nti yɛmfa say nipa 10 ɛna obi a hia dollar na dollar ne nso yɛ 2 aka $2 pe ɛna nipa 10 yɛ nyina hia dollar nti yɛ nyina de yɛ cedis ne kwa exchange a ɛbɛma price of the dollar no ɛbɛ kosoro nti price of the dollar ne kosoro that means demanders exceed suppliers, so the price has to appreciate. Acquire a scarcity say yɛ nyinaa yɛ didi na sɛ aduane no yɛ ketewa bi a yɛkyɛ a ɛbɛkyɛ ne ketewa bi anaasɛ yɛ obi wokɔ akɔtɔ ade koraa example COVID-19 ɛbaeɛ hand sanitizer price ɛkɔ soro paa deɛ cause na obiara hia hand sanitizer nti na ɔmo produce hand sanitizer no ɔmo ama value of the hand sanitizer price no akɔ high cause the demand exceeded supply nti automatically ɔsɛ price value no ɛkɔ soro. Nti example so hand sanitizer, same thing for currencies, trading. Sɛ amanfoɔ kɔgye dollar bebree a deɛ nti a dollar de bia na ne price ne wɔ soro ne sɛ globally obiara use dollar nti ama sɛ demand for the dollar is very very high. Ɛna cedis so who cedi no hane hia obiara hia cedi mfanya hwe una abɛkɔ akɔgye dollar, so then every day the cedi will be depreciating and the dollar will be appreciating because people need dollar to perform their business operations. Currency price move based on supply and demand, same thing we in a brofo and kobebia. Same goes for supply, more same thing my explain anyway. So let's talk about factors that influences the supply and demand. So we have what we call interest rate. They say to nyame mu affect it has effect on the supply and demand. Everyone say ukwa loan na loan na ubekwa kwa no kwa everyone say 1,000. Next is here no interest abetua was near 10%. Ubekwa say that be loan need meboka. So that one has effect on interest rate on that loan no cost abeka say that be this one they will not go for it, so it will have effect on the demand or it will influence supply and demand. Let me put it that way. So it's one of the factors that affect supply and demand. And inflation is the increase in commodities, price of commodities, increase in price of commodities. So when price of things go up over time, it has effect on supply and demand. And job data, I'm funny say ɔman Ghana say workers na ɔmo aha no ɔmo ndɔɔso a ɛbɛma ɔmo edwadie ayɛ ya kakra cause sika ni ɔman ni mu obiara ɛnyɛ salary saa nti no woni sika obesi da akɔ akɔtɔ adeɛ. So that one also has effects on supply and demand. And then government policies, yɛmfa sɛ yɛte ya na Mahama hyɛ mbra sɛ ma obiara ɛntɔ oil biom. It will make the price of oil no ɛma value bi ama oil so. So government policies also have effect on supply and demand. And a global event, yɛwɔ ha na sɛ yɛte Iraq for ne US for ɛntɔkɔ asi. Obiara mpɛ sɛ ɔne Iraq for bɛdi dwa ɛna obiara nso mpɛ sɛ ɔne US for bɛdi dwa cause bia na edwadie ni mu no ɔmo de ntɔkwa na ba ɔmo so it also have effect on supply and demand. And trade mood, if you are trading, there is something that we call sentiment, feelings, emotions, whether people feel positive or scared about the market. So no for young traders say me trading as a misro say me lose sika, and also have the effect on supply and demand. So all these can make a currency go up or down in value. Factors are interest rate, inflation, job data, government policies, global events, trade mood. All of them, they have they make currency go up or down in value. So I say my explaining BBA. So what's your one in Swasia? On the Asia, meet me taking it again.
Okay. So so but then you find say that government policies no on. Can it go two ways? If let's say with the example that you gave, say you are say currently the government will say that more behind to oil bill, and more behind using oil. And that also means that because the government no because money use oil, but still if any people here oil in internet. So still some way somehow I say your best one going to have prices now cost because there will still be demand for it, even though government is not allowing us to use it. And that one also happen.
Yeah, that one can also happen 100%. Yeah, it can also happen. So the point that we are trying to create here is all these factors can make currency either go up or come down in value, as you say. So that is the whole point that we are trying to drive over here. So let's proceed. Now let's talk about Forex market. The Forex market. So the Forex market, which is foreign exchange market, is where people trade different countries' currencies online. In this year, currencies trading and kasa. So we call that venture Forex market, foreign exchange market. So we trade online. We need internet connection and computer to do this trading. So it's where people trade different currencies. Sika and they trade it online. So how does this run? It runs 24 hours a day. In a day, it runs 24 hours. And 5 days a week. So it is more like 24/5. So Saturdays and Sundays we don't trade. We only trade from Monday up to Friday. Yeah. So across the world, every day about 7.5 trillion, it's not billion or trillion, is traded, making it biggest financial market. So the piano sika bebre, like if we are globally, we are trading online, you get it. So it sees that kind of money on the internet. So there is space for everybody to be a trader. If you actually want to be a forex trader, you can be, because sikane war internet in over trillion dollars, yeah. So that is it. Now let's talk about forex market participants. Who are those who engage in trading? And him for NA trading. So first one is forex is traded for profit and non-profit reasons. Some people trade for profit. Some also trade for non-profit reasons. So we will get to know all of them. So we have banks. Banks for some trade. We have brokers for some trade. Me explaining now one by one. Hedge funds almost trade. Companies almost trade. Retail traders almost trade. So banks trade currencies for profit and help stabilize them. Bank of Ghana, yes. They don't trade for profit reasons. They trade to stabilize the currency, the Ghana cedis. ɔmo mpɛ sɛ currency no ɛbɛ drop it gidigidi na ɔmo mpɛ sɛ ɛbɛkɔ high gidigidi, so they trade the financial market to stabilize the currency. Other local banks, they trade for profit reasons. Yeah, they actually trade. And we have brokers. Brokers are more like middlemen, giving traders access to the forex market. Until we are retail trader is say mene say a bit deposit sika to broker accounting na you start to see trading. So brokers, middleman and access to the market. So a broker is a middleman giving we the traders access to the forex market. Now let's talk about hedge funds. Hedge funds here, big investment firms trading huge amounts of money. Now we have companies. So multinationals trade to manage money across countries. Retail traders, I'm the individual traders. So in case I'm deposit or my account, I'm starting trade here. I'm called retail trader. Individual trading through brokers to make profit. So if say we create a brokerage account, they call me a retail trader. And if you also do the same, you are a retail trader. Yeah. So now these are the people who participate in trading. Yeah. So that is it. Now let's talk about advantages in forex trading. What are the advantages that we have in forex trading? So one, no office employees or inventory needed. We say here office gidi bi I say you full time and be here say obey your office kakra bi. But anywhere that you find yourself, you can be doing this. And employees high will be or inventories needed. You don't need any inventory. And only 3 to 6 hours a day is enough to do this trading. Yeah, if we have forms of traders, we will get there so that you get to understand it very well. So if you are a day trader, 3 to 6 hours in a day is enough to trade. So recession proof, not tied to one economy. So recession proof simply means there is no good or bad time. Let's say if an economic performance of Ghana is not going well, it doesn't affect you as a trader. What you have to do is we do two things: we buy and sell on the market. Same funny say we trade Ghana cedis, but we don't trade Ghana cedis on the financial market. I'm just using this to cite an example. Inti, we trade Ghana cedis. Let's say Ghana economy na performer. Nyobe say obe sell cedis, And I say we trade Ghana cedis. Let's say economy na cost run. Nyobe say obe buy cedis, Yeah. So it is called recession proof. It's not tied to one economy. So whether the country's economic operation is doing well, you can sell or buy. Like, yeah, we do two things: we buy and sell. So it is recession proof. Now, the amount of money you can use to start, you can start with as little as $100 or more. But if you are starting as a beginner, at least to test the waters, just start with something small and then see how it is done. Yeah. So we'll be starting with Sikaka Krabi. We'll see affected so that you get to understand, say, this is what you are getting yourself into. Yeah, so after say we're gaining much experience, now who say you can make much money from the little that you deposit, then you can just want to scale up by depositing bigger money. Yeah. Or even buying pro firms. Pro firms are companies that you buy accounts from them and they give you rules to trade. So so let's proceed. So next point is a high income skill for life if mastered. So it is one of the skills that gives you a very high income if so you gain any understanding now how to trade. Yeah, you'll be like you load money from the internet. Open 24/5. That one I think I have explained that. So you can trade anytime. You can trade, and success requires hard work and learning, because anything that is worth it has a price to pay. Bibia like price tag one. So if you can't pay the price, then you will not be able to get it. So success requires hard work and learning, because you have to learn and then be determined and persevere so that you wouldn't be like, oh, I didn't cry my bread. Because trading is but 1 year ube lose cancel. So requirements for forex trading. Requirements then I'll be here and sign why I started trading. What are the things that you need before you start to trade? So one, you need what we call capital. This kind of trading in fact in those and answer body and answer so we need capital, money to start. Can begin with at least $100, but it can be less than $100. Just that that is the amount I've given to anyone I teach. But you can start with less than $100. Roughly $20 of or $50 is enough. It's okay. But just say no be losing in 10 if say one year careful. Yeah. And we have what we call broker account. You have to create a broker account. So after this class, I will give you my recommended broker so that you create accounts with them. So a broker account, a reliable forex broker to access the market. So trading platform. So these are the software you have to download. You need last one is risk capital, money you can afford to lose. Make sure you don't risk what rent or bills money. So money you can afford. That's why whenever you're trading, you have to have backup money, like some money putting aside in case of any emergency. Yeah, you don't want to risk every money that you have. It's very necessary. And then we have what we call forex market sessions. We have the forex market sessions. So there are sessions as in time marketing be anytime active pan. So we have landing session and we'll be at 8 a.m. Now a close at 5 p.m. landing session from Monday to Friday be a at 8 a.m. Now close at 5 p.m. GMT. And it's the most active session, overlaps with other sessions, so it is the most active session. And we have New York session. That one opens at 1 p.m. now close at 10 p.m. and it is very high active or high activity, overlaps with London. It's very, very active. That session too is very, very active. On markets momentum and as fluctuations is very, very high during those times. It's about we are 1 p.m. to another 10 p.m. and no your landing session, New York session, and about 8 a.m. to 5 p.m. and only a landing session. And Tokyo session, that one is 12 a.m. to 9 a.m. Tokyo session is our friend Asian session, and they are sometimes less volatile. Less volatile means price movement, very slow. Now high volatile or high volatility means price movement is very high. And we have Sydney session. Sydney session is 10 p.m. to 7 a.m. overlaps with Tokyo session as activity. There is an app for that. If you want to know them, you can download Forex Trading Hours app to track sessions. You can download them. But for me, I just don't use market session. Just that I know them. According to how I trade, I don't use market session. But you have to know them. And then, in case if you actually want to do this as a profession, or if you want to learn this, you have to know the market sessions. There are 4: landing session, New York session, Tokyo session, and Sydney session. Tokyo session is also known as Asian session. Yeah. So that is the first slide. I don't know if you are tired. It's the episode 1. If you are you tired, or you can still continue?
I would like to continue.
Okay. So now we are done with the introduction to forex trading. Now we are going to consider forex currency symbols. Forex currency symbols. That is the episode 2. So the objective things that we have to know: the common currency symbol, currency pairs, base currency and quote currency, various types of currency pairs, the purpose of the base currency, types of currency pairs. See, these are the 6 things that we have to understand. Yeah. So now let's continue. Here are some common currency symbols. When you say starting in I say forex here, we are dealing with currencies. Yes. We don't write them as a complete. We represent every country's currency with an abbreviation. Like this Ghana CDC say, yeah, the CD sign, and I GH something. Yeah. Into euro no, EUR. So let me read what I have here. Forex symbols are in 3 letters, right? Forex symbol, they are in 3 letters. First 2 represent country's name, while the last letter is the country's currency, except HCF and only exceptional. In TSA, the forex symbols are in 3 letters. First 2 represent country's name, the 3 symbols. And we are saying that forex symbols are in 3 letters. First 2 represent country's name, while the last letter is the country's currency. The exception is CHF. So let's proceed. European Union Euro. That is the full meaning of Euro. European Union Euro. So the first 3 letters are the what? The first two letters represent the name of the country. So this is the first two: European Union, Euro. So EU, European Union, Euro. And is it Hong Kong dollar? Yeah, Hong Kong dollar. That is HK, Hong Kong dollar. And we have Singapore dollar. And then CSGD, that is the abbreviation for the Singapore dollar. And the Mexican peso is MXN, right? And Chinese yen, and that is CNY. Indian rupee, INR. Brazilian real, so Brazil, this is the currency they use, BRL. South African rand, so ZAR, South African rand. Canadian dollar, that is CAD, CAD. And then USD, US dollar. GBP, it is great. Let me type it. Great British pound, that is GBP. That is the pound, GB, Great British Pound. CHF, that is Swiss franc. The exceptional one was the Swiss franc. It says this is the name, this Confederatio Helvetica, formed from the two major linguistic regions of New Zealand. So this one is the exceptional one. AUD is the Australian dollar. That is AUD, Australian dollar. NZD, New Zealand dollar. JPY, Japanese yen. So these are some of the currencies that you are going to see on the financial market. So let's proceed. Can you see the next page? Are you there?
Yeah, I'm here, but I'm not seeing it. Hasn't loaded yet, so but I'm sure it will come.
Okay, no stress.
It is here.
Okay. Currency symbols. We are still talking about currency symbols. These symbols are widely used to represent the currencies in the forex market and are recognized internationally. Into symbols now, they are recognized everywhere. Traders and investors refer to these symbols when identifying currency pairs and executing trades. So if you want to trade currency symbols now, then you get to know the currency that you are trading. So it's not anything difficult. So yeah, we download the MT5 now, be also. It's any big deal. Yeah, any difficult. Currency pairs. We have the forex trading. In forex trading, currencies are traded in pairs but not a stand-alone. Nti wote pair okoto battery aka say mpacho metal pair. Nti wote pair, that means consist 2 or 1-2 pair. So we don't trade as a standalone. We trade by involving two countries' currency, because it is more like you buy one and then you sell one, and you buy one. See, we don't trade as a standalone. These pairs consist of a base currency and a code currency, coded by International Organization Standard IOS. Here is a list of major currency pairs commonly traded by successful traders. So we don't trade them as a standalone. You find say if you say me trade Euro USD, Euro no one country's currency, USD no another country's currency. Into Euro and the dollar, me trade Euro and the dollar. So either say meto Euro no, me the dollar ni better Euro no, and I say me the Euro ni better dollar. So that is the two things that we do. We buy and sell, we sell and buy. Yeah. So now we have some common currencies that we trade. We trade one, GBP USD. The GBP is Great British Pound. Why didn't I write Great British Pound? And then USD is US dollar. So we pair them. Come boom near trading. We pair them. So, and we have USD JPY, that is the US dollar, and then Japanese yen, and USDC. Are you saying something?
Oh no, I guess. Oh, I was saying that you like when we were asking say pen or kind of trees, and then I was contributing.
Okay. No stress. So USD CHF US dollar, and then against, we say USD CHF is US dollar against Swiss franc, or USD CHF USD against Swiss franc, or AUD against USD, that is Australian dollar against US dollar. And NZD is New Zealand dollar against US dollar. USD CAD, that is USD against CAD, or Canadian dollar. So we pair them. We don't trade as stand alone. Yeah. To bet in later, because we know basics. Now let's talk about base currency and code currency. Base currency and code currency. The base currency is the first currency listed in a currency pair with a constant value of 1. What you say? Base currency. When say a pair them, we pair two currencies. Yeah. So we among those two, we have one called base currency and another called code currency. So then the definition for the base currency is the first currency listed in a currency pair with a constant value of 1. The pairs, at the back now say a friend base currency. And that base currency, you say the value 1 with a constant and it represents the currency you are buying or selling. The currency now be buy and sell be selling. I don't know a base currency. For example, in currency pair euro and then the dollar, the euro is the base currency, meaning that euro is having value of 1, and we will buy euro or we will sell euro. That is the base currency. Now, what's the base currency, Nasi? Okay, and then let's go ahead and talk about code currency. Code currency is the second currency listed in a currency pair. It's image na wahaya your euro and your USD. You see base currency ni euro, and the value 1, and a code currency no dollar, US dollar no. You know the can same be brain fan. So we are saying that the code currency is the second currency listed in a currency pair. The code currency is used to determine the exchange rate and represent the amount of code currency required to purchase 1 unit of the base currency. Inti you see the biano base currency ni value near 1. Inti code currency ni the chair ahe in able to make code currency na to 1 unit of the base currency. In fact, say me want €1 and you say €1 near constant. And I me want $30. And $30 and you say a code currency. And inti sa code currency na chair me si kadodo a me to me they to €1. And him say what you say sir. Yeah.
Okay. So let's say if we are to bring it into a normal market here, say when you are going to trade a laptop, and me scan a laptop, let's say laptop on a
base currency. Yes, and the price near fixed.
And the price near fixed. Into say me here, and the cash that I'm going to use to buy the laptop is the code currency.
Yes.
Right. So code currency laptop on maybe 5,000, meaning we have 5,000.
Exactly.
I mean, we have 1,005 to buy 1 laptop.
Yes, exactly. That's it. So that is the code currency and then the base currency. And any big deal behind. See any pair be biana first listed pair no AFBI code currency and base currency. Second one near code currency. So let's proceed. So the purpose of the code currency, I think we've explained that the code currency tells you how much of the code currency is needed to buy 1 unit of the base currency. For instance, if GBP USD, that is Great British Pound against US dollar, exchange rate is 1.2100. It means that 1 British Pound can be purchased for 1.2100. Because you see base currency there be any value 1. Until it has a GBP near base currency and a dollar a code currency. Now example when you say exchange rate for the USD 1.200. It means you will need this amount to buy 1 base currency, which is the pound or Great British Pound. Yeah, so that is it. Example now in with the laptop now. So it's very simple. Now let's talk about types of currency pairs. Types of currency pairs. We have types of currency pairs. I hope you can see that on the screen.
Currently, it's not showing, but I'm sure it will come.
Okay. Types of currency pairs. We have major currency pairs. Major currency pairs refers to the most actively traded and widely recognized currency pairs in the Forex market. These pairs involve the world's largest economies and their currencies. So, for instance, let's say major currency pairs, a currency you trade. If you are seeing trade pan, and it is the world largest economies. To say US economy, very big. So, their currency is the dollar. So definitely, we will trade the dollar, and it is much active, the most active used currency, dollar and Europe. I'm gonna say euro no, I'm say no, so your for trading. So the major currency pairs are the most actively traded and widely recognized currency pairs in the Forex market. Now let's mention some of the major currency pairs. They are 1, 2, 3, 4, 5, 6, 7. We have 7 major currency pairs. 7 major currency pairs. The first one is euro against US dollar. The next one is GBP against USD. And the third one is USD against the JPY. And USD against Swiss franc. Australian dollar against USD. NZD, New Zealand dollar against USD. And USD CAD. USD against Canadian dollar. Yeah, so there are 1, 2, 3, 4, 5, 6, 7 currency pairs, major currency pairs. So currencies when you trade it. Now let's proceed. We have exotic currency pairs. Exotic currency pairs involve the currencies of emerging or smaller economies paired with major currency pairs. These currency pairs have less liquidity, higher spread, and are considered to carry higher risks due to their less predictability nature. Some examples of exotic currency pairs include USD TRY, that is US dollar against Turkish lira. So exotic currency pairs in trade because economies ni emphasize Ghana say your currency is exotic because we are now emerging economy. Into your currency in so we don't trade them on the financial market. The reason is this dog. The reason is have less liquidity. Liquidity simply means money. Have less liquidity, higher spreads. Spread knows you drew here, and are considered to carry higher risks due to their less predictability nature. So that is why we don't trade exotic currency pairs. Those are the reasons. Now let's talk about now this is also exotic. Exotic currency pairs require careful analysis and blah blah. Simply put, we don't trade them. So these are the two major types of currency pairs: exotic currency pairs and then major currency pairs. There is another currency pair called cross currency pair, but that one I don't think I involved it in the slide. Cross currency pairs is any pair of currency that is not having US dollar, like any currency that we don't pay it with the US dollar. It's called cross currency pair. You can say euro against JPY. That one will be a cross currency pair. Let me show there. Yeah, this will be used to GBP against Japanese yen. It is called cross currency pair because Great British Pound no man fan pair any US dollar. Me pair yen, Japanese yen. And I say me BB say AUD against CHF. It is called cross currency pair. Any pair USD any mubiano is called cross currency pair. So currency pairs. It is recorded, so if anything you can refer from the video. So the next session will be Forex market terminologies, some of the terms that we use in trading. So there are some couple of terms that we use. So in every industry, you have to know the language of the industry. So in trading too, we have our language. So we want to know what PIP is: leverage, lot size, spread, PIP value, standard lot table, margin, equity, order, sell stop, buy stop, buy limit, sell limit, stop loss order, take profit order. So these are the various terminologies we use in forex trading. So let's proceed. PIPs or PIP. Now PIP, you can see it is even part of my name, Free Pips. That is the brand. So PIP stands for percentage in point or price interest point. That is the abbreviation and the meaning of PIP. Yeah, so a PIP is the smallest unit of measurement used to indicate changes in the value of a currency pair. We say currencies no, our values in the movie. A change is the what? The PIP is the smallest unit of measurement used to indicate the changes in the value of the currency pairs. Into a paper, can say a measure. Can say the smallest unit of measurement used to indicate changes in the value of the currency pairs. So, if I say currency na at 2, and as you see about that 3, the difference, any other friend of PIP. So difference will be 1, and so we call it 1 PIP. So let's use this one as an example: euro and the dollar, right? So we have the euro value to be 1.1498, and then USD value to be 1.1498. So now the original price for the euro was at 1.498. Nti changes abem hanababe 1.499. Nti difference in the price 1. Nti first one no a pip.
Okay.
Yeah, so it's the smallest unit of measurement used to indicate changes in the value of a currency pair. For most currency pairs, except those involving the Japanese yen. A pip is the fourth decimal place of the quote currency. So we have quote currency we USD no na quote currency. The fourth decimal place no we be counting 1, 2, 3, 4. So a paper no we home paper no value no a four decimal place. Let me read it so you understand. For most currency pairs except those involving the Japanese yen, a pip is the fourth decimal place of the quote currency. T with your quote currency difference with the base currency near 8. Now quote currency near 9. So that is the difference between the 8 and the 9 is 1. So now we have 1 pip. Now let's play. For example, if your USD moves from 1.3500 to 1.3505, that is the fourth decimal place, 1, 2, 3, 4. The change is what, 5 pips, because originally it was 1.3500. Now price has moved to 1.35005. The change is 1 pip. Everything will make sense if we get to the chart. This here has a theory in American, but it do practical now. Ubeti be as simple.
Okay, but why is it that the Japanese yen takes a point?
Okay. Except those involving Japanese yen, a pip. Yeah, okay. So, Japanese yen, no, almost price list is different. Let me show you. JPY. USD JPY. Yeah, so we are no yeah counting on people from 0 2 decimal place.
Okay,
this one is 2, but the norm aside this one, all of them is having 4 decimal place. Until you has a price na can na any and currency no any. So we USD left corner baby I'm doing any issue we USD JPY. Until you see USD no value no there be a base currency no value no there be say 1
yeah.
And base currency no ube here quote currency and now they are quite base currency. Until quote currency no price na list wa ha no and na egu ase no be brain na wa ha se well until see no hwa chart na do ha se until price do 155.784. until 155.784 no actually say for 1 USD no ube here 155.74 and so na akoto wenya exactly yes. See the quote currency in any base currency no any until na make the info
now you can pip and then
yes pip until me pese me hu from line way that hey a value of 156.0603 we pese me hu pips baby as see a price abedru a cover price abedru 155.7364. You pese me hu me pa me subtract kitwa na free kase anim na me hu the difference distance na a cover. Say before na price wa ha and ba ha se we cry 2 mpo ho I did determine 2 we say any determine pips until we say 32 pips difference. Until me 0.6 minus I really don't want to make this thing anything complex. Say we say make na me sell market no ha say and as you see market na ba bedru a until pese me hu amount of pips a cover ya there is a 2 for that, so there is no even need to know those stuff. The way 2 we say when you add the 2 now I stretch no now my value no 32 pips difference. Until me sell what extra ha say you sell to with the better I say how you take profit now how you stop loss. This here we pese how much unya pips in 32 pips. So even the ones I've been telling you, no one should die you see, we are now be you see. One should die here, just say you have to just know it. Yeah, just have to know it. So now we know the difference between pips. We know the meaning of pips, right?
Yeah.
Leverage. Let's move on to leverage. You can say pip meaning a percentage in point or price interest point, and you say the smallest unit of measurement used to indicate changes in values of currencies. Simply put, you get to know what pip is by knowing the difference in price. Yeah, price movement, the difference in price movement. As simple as ABC. So leverage in forex trading refers to the ability to control a large position size with relatively small amount of capital. Yɛmfa ne sɛ wode deposit $100 you need leverage. Leverage your capital a amplify $100 to buy some units of the base currency. Yeah, so let me read. Leverage in forex trading refers to the ability to control a large position size with relatively small amount of capital. It is expressed as a ratio such as 1:50, 1:100, or even higher. For example, with 1:100 leverage, a trader can control a position size worth 100,000 US dollars with only 1,000 of their own capital. And instances say $1,000 now you see 1:100 leverage 100 times the $1,000 that you have. See, multiply 1,000 by 100 you get say 100,000, right?
Yeah.
I know what you say. With that money now, we initial capital near $1,000, but you see leverage leverage of 1:100. I know what you say. You are now controlling 100,000 account. You see our account number by 100,000. That's the meaning of leverage. So if you download MT5, if you have access to a broker, they provide you a leverage to be able to control large position size. What deposit $100 now we use leverage of 2,000. That means $100 times 2,000 will be the money that you'll be controlling. There are advantages in leverage and there are disadvantages in leverage. Advantage in leverage in say we need trader, you get to make more money, but we lose trader, you get to lose all your money very early. So it is more like two-edged sword. And mostly leverage we consider it as the money that the broker borrow you to be able to control large position size or to have a large capital. So what deposit $100 now you should leverage of 1:50 brokerage account na $100 times 50 and ebema that capital to control. Nti akwa say broker no aboro sika opese account ni mu edu na to me trade na onye sika. But then men can say say to amplify you to be able to control large position size. You do chart in so I made demonstrating in na what you say. Just me person me introduce theory no now into the main kind with the purpose of leverage. Leverage is used to amplify both potential profit and potential loss. While it allows traders to increase the size of their trades and potentially enhance returns, it also increases the risk as losses are magnified. Bought or sold in a trade. Into a trade base currency do obeto and on a loss size and on it give you the meaning of loss size. So we're saying whenever we are trading, we don't trade as a standalone, we trade in pairs. We need two currencies before we can trade. So the first currency is called base currency, the second currency is called quote currency. Now to buy the base currency, you need some units, you need some lot size, and the quantity of base currency that you will buy is what will determine the lot size you will use. And over here we have lot size table. Now we have lot size, we have standard lot, mini lot, micro lot, and nano lot. And the unit is the amount of lot size that you buy. So now for the standard lot, we say it is 100,000 units. For micro lot, we're saying it is 10,000 units. For mini lot, we are saying it is 10,000 units. For micro lot, we are saying it is 1,000. Now let's move on to the volume. Nano lot is 100, but we don't use nano lot. That is why I always don't place much emphasis on the nano lot. So the volume is also the amount of units that you buy. So its equivalency, volume equivalency is units. So for the standard lot, we're saying one standard lot is equivalent to 100,000 units of the base currency. One standard lot, equal to the amount of base currency that you buy, which is 100,000 units. And mini lot, 0.10. And its equivalency to the unit is 10,000. And now micro lot is 0.01. Its equivalency to the unit is 1,000. Now let's move to the pip value. Pip value is the amount of pips in a currency or in a monetary form. In a monetary form is the pip value. So let's say you use a volume of 1, which is the standard lot. We are saying every single move of a currency is called a pip. if let's say price was at 10 and it moved to 11, the difference is 1. So that 1 becomes a pip, 1 pip of the movement. Now, that 1 pip, the money that, in case you used one lot size to execute your trade, the money that you will make will be $10.
$10.
Yes, exactly. If you use mini lot size and price move from 10 to 11, the money that you will make will be $1. If you use micro lot size, the money that you will make will be 0.1. So as simple as ABC. Until you call real chart in this one, make sure how be you see lot size in BBR.
Okay, so I want to ask a question here.
Go ahead.
All right. So in the same way, let's say you decided to buy, okay, and the market doesn't go in your favor. Let's say you use the standard lot. It means that in every difference to the same way that if we were to gain, you're going to gain $10 each. In the same vein, when it declines or if it doesn't go your way, you are going to lose every difference in the paper. You are going to lose.
Exactly.
All right.
Exactly. So the difference that we will have here is if you are setting a stop loss, there is something that we call stop loss. You get there and then I will explain it to you.
Okay.
So you give a range of amount of pip that you want to lose and the range of amount of pip you want to make. Let's say you set a stop loss like 5 pips difference. If price move against you 5 pips, it should kick you out from the market. So you risk money according to the 5 pips. And if you say, and we also said take profit. Take profits is like putting price far away from your entry zone and you are expecting price to go in your favor, and the amount of pip that price will cover will be much more than the amount of pip that in case if you are to lose. I mean, I don't want to rush things. So if we get there, I will take my time and explain it to you. So I think your question is answered, right?
Yes, sir.
Yeah. Then we move on to spread. So yesterday we were talking about spread. Now I said spread is what the money that the broker charge you for, like the fee that you pay to be able to execute trade. That is the simplest definition. So spread refers to the difference between the bid price and ask price. And ask price, bid price is the price at which you can sell a currency pair, and ask price is the price at which you can buy a currency pair. Into Euro USD, you see this as an example. Euro USD price was first 1.16216, and that is the bid price, the price at which you will sell. Now the price at which you will buy will be 1.16221. That is the bid ask price. Yeah. Into when you know you broke canon edit so that obenya charges a free. Yeah. Now traders prefer currencies pairs with tight spread as they minimize trading cost. Until trade be an say pair now trade a major currency pair. I think we considered major currency pair because I made a video and maybe I for the amount no go through. Yeah. So who trade be a currency pair now we use or tight spread, and if spread no a wider, that means that you are going to pay much fees to be able to execute trade. Until be am some person be Jessica guessing to be say who use loss spread pay our smaller spread. I just here. Now pay value. Pay value represents the monetary value of a pip movement in a currency pair. And no can one say the way a pay value. Yeah. Now let's talk about margin. So margin is the amount of money that a trader needs to deposit with their broker in order to open a trading position. And this can ube deposit at account in no friend margin. It is a percentage of the total position size and represents the trader's own capital. Until you can now say $100. $100 is your margin. The rest of the position is often funded by borrowed money. So you can say margin is capital minus leverage. Is that the formula? Margin is calculated as a percentage of the total position size, and is usually expressed as a margin ratio. For example, if the margin requirement is 1%, a trader would need to deposit 100,000. A trader will need to deposit 1,000 to control a position size of 100,000. And see, so leverage is a broker and provider with leverage. Leverage is always like a borrowed money. Leverage in forex trading refers to the ability to control a large position size with a relatively small amount of capital. And see, ratio we say you see 1:50 leverage around. It is representing your capital. And now 50 is representing the money that the broker borrowed you to control large position size. Until an example, what deposit $100 our accounting, and where you see leverage of 150. Until $100 is this one, and the leverage will be 50. So in that sense, you multiply the 50 to your $100, and it will tell you the amount of capital you are controlling, or the amount of money you have in your account to take trade. Into $100, times 50, we're saying
5,000.
5,000. Yeah, that would be imaginary. If you are imagining it, it is 5,000 position that you are controlling. I mean, 5,000 capital. Yes.
Okay.
Yes. Inti, no. Sika broker now use or they borrow so that you can open match positions. What you say? Yes. And margin no say leverage enka o capital ne ho, that is what we call margin. That is what we call margin. Margin is the amount of money that a trader needs to deposit with their broker in order to open a trading position. See, with $100, that is your margin. So it is without leverage. It is a percentage of the total position size and represent the trader's own capital. So your own capital is your margin. Now, formula for margin is not really necessary. Margin is calculated as a percentage of the total position size and is usually expressed as a margin ratio. For example, if the margin requirement is 1%, a trader would need to deposit this amount, 1,000, to control a position size of 100,000. And see, this one, it will be more like you are using 100,000 capital by depositing 1,000.
Yes.
Yeah. How do I even make it very easy? If a scenario, we are making it easy. With this $100,000, there is leverage attached to it, but this was your original capital, which is $1,000. Now, who you see $1,000 now you reach to mechanism leverage, about 1:10, right? So multiply 1:100.
100.
Yeah. Leverage never be 1:100. So with this example, leverage 1:100. So what is here, right? Orders are instructions given by traders to execute trades at specific price level. In TCL, we take it trader, we call it order. You give the broker an order to place your trade for you. Now, market orders. We have market order. A market order is executed instantly at the current price, at the current market price. You simply buy or sell at the prevailing price in the market at that moment. That is market order, or we call it instant execution. You buy, now you sell it. We buy and sell on this financial market. So there is another form of orders. We have buy stop and sell stop. So this is a buy stop. It's a pending order placed above the current market price. It is used when a trader anticipates a breakout above a resistance level and wants to enter the market for a buy when that level is breached. It is you see buy stop abbreviano, you buy when price is low. We buy when price is low, and when we buy, we expect price to go up so that we will make profit. And with this image, you find say has a resistance, if it be resistance, and a price was below the resistance. Now we expect price to break above the resistance. You find say before the price will break above the resistance, we wouldn't be available to monitor our trade. Until you say you best set buy stop or buy stop limit. You best set limit near Jaho. Until the price break above this resistance, take here into the trade automatically. So it is a limit that we place above a point that we think price will break and continue pushing up. Let's go to the real chart. Let me explanation. Now, you find say we resistance or ha. We I mean you see we very clear. You find say we resistance or ha. Let's say me say price e be break here e be to aso akosra. The man say me set it buy stop. That means price e break way na and trigger me entry no nemfa enkosro like na enkosro. Yeah, that is the limit order to place. Now for buy the next point. But what if I stop now? Say, won't you say I'm taking it? Why? Because
so I want to explain and see if send your time on Sana.
Yeah, cool.
So I had to say, if I say your call market, so I don't know. We want to buy though, but price no. So say if I say it will low, and we want it to get to a certain level and Sana yato. You know, yeah, the CKJ.
Yes. Exactly.
Uh-huh.
Exactly.
And you know, do 15 cities, and you say do 20 cities, do 20 cities now automatically one month
Exactly.
because you are going, it will go up to let's say 50.
100%.
All right,
100%.
all right.
Yes.
So that's the buy stop.
Yeah, that's the buy stop.
All
100%.
right.
And yeah, what sell stop? That
Mm.
one too is opposite or vice versa for buy stop.
Buy
Pending
stop.
order
All right.
placed below the current market price. It is used when a trader anticipates a continuation of a downward move and wants to enter the market when the price falls below a certain level. Nti wohwɛ wei a sell stop no ni. Na price no ɛwɔ soro. Ɛnkɔ chart ne so.
All right.
Ɛmfa ne sɛ I mean hwɛ sell market. Alright. Ɛmfa ne sɛ yɛhu resistance bi wɔ ha. Aha sei. Aha. Ɛna na price ɛwɔ soro. Aha sei. Nti yɛse aha sei ɛyɛ resistance. Nti sɛ price ɛba fam na ɛbɛduru ha automatically wobɛsɛte order anaasɛ wode wo sika no bɛgya wɔ ha without you being available. Wode gya wɔ ha na ɛduru a ɛntrigger wo entry no na ɛnsɛɛle.
Okay.
Ɛno no wo expect sɛ price no bɛba fam. So what is there? Yes. So that's the explanation for buy stop and sell stop.
All right. All right.
Now let's talk about buy limit. This one is also a pending order placed below the current market price. It is used when a trader anticipates a potential reversal or bounce from a support level and wants to enter the market at a lower price. Now, scenario for a buy limit in here. You see, I may train my set buy limit to say. I may train. So price better for more. Now I bet take me. To we say a buy limit say price was low. To me expect say buy for more. Now me need chart in here. And taking me entry. And taking me entry. Then fan cost low. As you say, we a buy limit, not buy stop. This is buy limit.
So the limit when it gets to that place do you want to still continue because right now you are buying, right?
Yes, I'm looking for a buy opportunity, but then
Okay.
my expected price be retrace or be pull it down. Now below, now I be hitting me entry for a buy. But what you say? But for a buy stop, no, who expect say as price is going up, no. So we say now your resistance say a break you now per say end to us on cost.
Yes.
So you place always buy stop above resistance zone. Now,
Okay.
now buy limit, no, you place it below the resistance zone so that in case price fall down, you get it at a cheaper price.
Okay. So the both you still buy, but
Yes,
one will be at a convenient side that will make more profit.
Exactly.
Which is the buy limit.
Yes.
Okay.
See, say expect it price to continue with the upward move. Let's say entry no. When you're at a very low price, let's say still now who's a price a break is on be a better aqua. Then you set a buy stop.
Okay.
Now say expect say price a buy never from beam now buy for entry be and sign a cosra. Then you set a buy limit.
Okay.
Yeah. That is the whole difference. Now, same thing for a sell limit. Sell limit pending order placed above the current market price. It is used when a trader anticipates a potential reversal or pullback from a resistance level and wants to enter the market at a higher price. So, you're charting so. So, me person me sell here, me say price ever down. Sell market, sell trade no you say price was low. Now we expect to say ever form. In the end, say we say no was low. I say it was low. And I say na nko sen ka me take sell no. But then me be hu chart no ya sell ya ba bedru ha say. Nti you hu say there is a reason to wait for a pullback. Pullback means price I say breathe in, breathe out. Ebe ba bontins ebe ba back say na ba na sa sell. And also no me set sell limit e wa ha say.
Okay.
Yeah. If say me hu market na a sell ya ba bedru but then me pese me sell wo low way but me sell wa ha. Then I'll set a sell limit over here. And then when it got there, price sold. Price. Ni na your orders are placed on the chart. You do practical aspects now. Very, very simple. Very, very simple. Now, stop loss. Let's talk about stop loss. Stop loss is also an order. It is used to limit potential losses by automatically closing a position when the market reaches a specific unfavorable level. Your chart in this one. Okay, Nehemiah Wahaya, we higher entry. Nti me set buy limiter. Nka ha say na me buy limit ni wo. Na price a trigger me na go me direction. Na ma set stop loss. Stop loss here say price and go up from this entry point and cause your entry point to hana. Na say back ebeka the end of this red line and keke me out automatically. That one is a loss.
Okay.
Now let's use the pip that we learned. Here, Abi, you can see my cursor here.
Yes.
I picked the entry when price was at 5089.36. This is the entry. And stop loss no, 5073.67. Into Nina explanation in I say may buy what I say, but if the buy now go in my favor, and I say Ebeka, we are a baha, I should be out of the market automatically. Now, to know the amount of pips a cover here, meti way every way, meti kitwane free. Yes. Now the pip. Till now, meti way every way there is a tool that we use for it. Here we are.
Okay.
Into way 150. This is good. Good calculation of pips is quite different. When your value here, then you multiply it by 10. No, in Drew have a thing.
We only multiply the first two, no, by 10.
Yes. So we are 150 pips. This particular trade, no, 150 pips risk, and I'm take here. Then my set limits, no, na me stop loss not to us is a price be drew her. With this movement of 150, no, I'll say hitting me out. Now, if I used one lot size, it means that from this zone to here, I will lose times 10 will be
15.
how much?
No, 150.
150 times 10 will be 100,000. 1,500. And he said, me lose this amount stop loss na 1,500 na me risk it. So me you see one lot size what you say? Yes. And I say me you see micro lot size and not just say which was 0.1. And not just say every single movement of the people behind how many? It was 1. I mean check.
So 0.1 wait.
Okay. And only $1. If some you see mini lotter.
Okay.
Yeah. Right. If some you see mini lotter, $1.
Yes.
And I'm Lucy. Every single people behind. Every single me multiply then that will give me the value. But then on the chart, you know, on my in such a way say calculation has to be very easy for you. See, there should be an order. Place order now. Ube value I'll be Lucy. Now ube make it. Ube huni na until you say or make corrections be about not risking too much. You can see the amount of money you lose without the need of you going through to do this calculation and everything. See, for my mind, BPI is simple. Just say I just want you to know how the thing is. Yeah. See, very very simple. Now we were talking about stop loss. Zone we say I'm surprised it go against me, then I will lose this amount. Now let's say price kujami. Let's say I was buying here. If you hear long, it's the same as buy. If you hear short, it's the same as sell. Long is buy, short is sell. Me find say me take buy bi waha. And I'm setting stop loss waha. Timi entry ni 5,281.47. Timi buy yana price eba back and eba hit me stop loss at 5,274. Now this will automatically get me out of the market with a loss.
Yes.
But then if say me buy na me stop loss waha. And there was this sharp movement to this down, to this low. And it's never hit the stop loss. Yes. That one we call it drawdown. And on lose here and kick you out yet, but you are in drawdown. We call it drawdown. Until a bit me back. Now Baba profit. So the C blue that you are seeing here is profit target. So always we maximize profit and we minimize loss. So here, my stop loss zone the amount of pips and person me risk now now the amount of pips and person me cover no So we have what we call risk to reward ratio. Some funny say risk $10 Ube expect to say ube make it $30 at least. So you are always expecting much returns whenever you are risking money. Same funny say with this particular trade. No one's on my BBM risk/reward. Risk/reward. It's we say with this trade, no, a 1:3, 1:3.28. Risk side, you know, 1, no. Risk side near 1, and a reward near 3. Yeah. See, that is there. We drew I say, but then you have a chat in this internet. Me person me share now. What's it? Honest, what's it? To risk it now. The minimum risk to reward that you would expect is times the way of your risk. The minimum times the way of your risk, according to anybody that I teach. If you are risking 1, expect 3 in returns. If you are risking 4, expect 16 in return. So yeah, business way, I do way in a form of business. So risk it 1 now and expect to be making 1. I be make it times 3. That is the minimum for me. Yeah.
Okay.
Until we me train trade be what I say. Me who reason be I also me train opportunity for a buy. Until me risk to reward no is at 5,300. Until you see straight away say price go in my favor, I will make times 6 of the risk I'm taking. If I say me risk $100, me make it $600. Yes. Until when we lose $100 now, next opportunity no, I will say a cover. Next opportunity, next we need that next opportunity. I will say I cover the loss I took on this one, and then give me additional profit. Yeah, so that is the way we trade. That is how we trade. Until I say me deviate. Enko what we are considering. In skip PBBR.
Okay.
Me take it things. Now we were talking about stop loss. Now I think we know what stop loss is. The money that you are risking. Now take profit. Used to lock in profit by automatically closing a position when the market reaches a specific favorable level. Until where we are. Well, price do 3,500, 5,300 now reversing. So here we are at this area, no price back. If I do has a call in my direction now, it will automatically close my profit for me. This is current price. In any stable, a movie, he said that 5291. 5291. 5291. When we changes this year, a fluctuate, it's not stable. It is a price a bar has a nice besinko this area. That one will be my profit target. As a balance a back came out from here, that will be my loss target. Now let's proceed. I think what to take profit in is what I say. Yeah. Both stop loss and take profit orders are essential. That means they are very important. They are essential tools for risk management and trade planning in forex trading. So we just don't do anything anyhow. Any trader you take, you have to plan for it. When we say me train trade be and yes be ama market in cost na me chase say me buy or say me buy market in from na me chase say or say me sell. Now yes hunters, we wait for price to come to a favorable point, and that is when you need a strategy to join a buy or a sell. They always say they drew. If you remember, my planning trading is a entry has seen me take entry pepe now me stop loss on the price a breach me entry and say a buffer down and hit me in free marketing. So if I'm risking $100, I mean say this particular trade the $100 na me risking. And if I'm expecting a profit, I mean say this particular trade I'm expecting profit of $600. $600. Yeah, because it is 1:6. $600. Yeah. Then the $600 profit, my capital and crown mayo. Then I'll add it to my original capital. That one will be my profit. No, that one will be my equity. Yeah, let me put it out. That one will be my equity. So me make it profit on this one now. And I say, profit plus initial capital will be my equity. Yes. So that is it. See, I take stop loss. I take profit. I take buy limit. I take sell limit. I take sell stop. I take buy stop. Now let's proceed with what else? Yeah, that is the end of that session. Now this is what we called market structure. This one deals with strategy. But before I say about starting market structure, I will say you practice it on MT5. I mean download the MT5 CC our app store. So we are talking about market structure. Market structure, if you never become aspect of strategy. Strategy will be you see to do trading. Or I think so. You know, I have February session with students, and no me share strategy no kwa. Nti for now no, I think it would be
Oh,
best to practice what I've taught you with the basics. Nti basics no eba be use MT5. Nti drew strategy this one February session and mature strategy no, cause much stuff will be taught during that session. Eba. And I'm brief explanation because it will not take much time, so that get ourselves into that particular course, you would easily get it. I mean, a brief explanation. So objective: market structure, trending market, consolidation market, choppy market, market structure concept, going long, buy market, going short, bearish, sell market, kinds of forex traders. I think we've done this, or we've not. Position traders, long-term traders, swing traders, day traders, scalpers, candlestick anatomy. Now let's proceed. Market structure. This is the behavior, condition, and current flow of the market. Basically, the current order flow of the market. TSC market, you know, there was some particular characteristics, or attitude be performing on the chart. A go, a behavior in certain way. And then a friend of market structure. That way that it behaves, you know, any friend of market structure. Now let's talk about the ways it behaves. We have two forms of behavior on the chart. That is first type, the types of market structure. We have trending market, and then the second one we have ranging market. Into behavior now happen on the chart, you know. We have trending market and then ranging market. Now, for the trending market, we have what we call uptrend and then downtrend. Uptrend and downtrend, and then we have a ranging market. So the point we are drawing here is we have two main forms of market structure. That is basically the behavior of the market. There are two main behaviors on the market. We have trending market and then ranging market. And under the trending market, we have what we call uptrend and then downtrend. Now, young coach charting so me person me demonstrate PPR na. Market in a course we see a behavior, a course like a pattern it is following, and that becomes the behavior of the market. So a course we see and your friend is saying uptrend. A course we say no, a friend uptrend. Na say a bafoma, and course rosa a performance. But currently we are in an uptrend market. Market na won't see a market a bullish market or uptrend market. I say we say a bafom into one of the behaviors into a downtrend over here market. See, you have a break of structure. I mean, do I mean to me, bossy. Bafom say a BB say a downtrend, but a BB say a cost say ya. It's chart in a cost a uptrend. Uptrend. Now, range market. When say market, you know, a cost sideways your friend range. A cost sideways. Your friend range market. Inti, I say market, you know, two major things. It trends and it ranges. And if it is trending, it is either going up or it is coming down. So that is the whole point for market structure. The definition is the behavior of the market. And now we are saying the behaviors of the market. You know, there were two major ones in here. Either say a trendy and I say a rangy. I say a trendy, either say a costro and I say a buffer. So that is the meaning of market structure. Now, you can see uptrend. We are now considering uptrend. It's when the market is making series of higher highs and higher lows. With this image, we have I mean real charting, so that one will be very simple. The skeletal aspect of uptrend is price is creating some series of this like stairs. It moves like stairs or waves. With an uptrend, I have say a label pattern. You swing high, and I say your friend swing low, and your friend impulse. ɛna ha sei yɛfrɛ no correction na ha yɛfrɛ no correction. Nti for an uptrend definition, you can also define it as this: is when price creates series of impulse and corrections by breaking swing highs.
Okay.
Tiaha was a swing high. The price impulse move way if you have impulse into when you impulse, when you impulse, when you impulse, when you impulse, way air correction, way air correction, way air correction. So you can define with this structure I have here. No, you can use it to deduce a definition for an uptrend. So you can say when price creates series is you want to see multiple series of impulse correction, impulse correction, impulse correction, impulse correction, impulse, and then correction. So you say is when price creates series of impulse and correction by breaking swing highs, by breaking series of swing highs, swing highs, swing highs, swing highs. To a market structure definition for uptrend. What you say? One of the key concepts I was able to what you say pantina mateki me slow down. Ti wo hwa me say every move way impulse. Na ne beba form ne afre ne correction. Na next baby a turning point ni see your so your friend swing high. Na baby a turning point ni see your form hand your friend swing low. Into impulse we say also make who say a breaky the swing high no. Ti a breaky swing high na automatically we call here break of structure. Ti a break of structure. May introduce here adebako aka ho. Break of structure. It is yenya breaky swing high way no. And your friend break of structure. Break of structure. And I'm in short as BOS, which is balls. And now we break of structure. So that means a break of structure. In the price a breaky structure be so slow her. And as a breaky structure be. This we are talking about uptrend. The uptrend I consider this here and a breaky structure. So for you to identify an uptrend on the chart, always your focus is which swing high was market able to break, and then what was the impulse that broke that swing high. The series of break of structures. Now you can identify an uptrend by knowing say price a movie in a wavy form, and when that wavy form forms, it has to create series of what we call swing highs and swing lows. I have say a swing high and a higher swing low, and a higher swing high and a higher swing low, and a higher swing high and a higher swing low, higher swing high and a higher swing low. Now maybe be introduce here adebako aka ho. Your first swing high way, higher high.
Okay.
Higher high. Higher high. And a swing low way. And so your friend no higher low. Higher low. Now a very self-explanatory. A higher low and a higher high. That means high way. It is. I mean you see. Oh, I say. I mean starting free here. Come on. I mean starting free here. We answer a high sir. But you pay attention how.
Okay.
So highway, a watching way. And the internet for higher. There should be another high viewer. Now man we say no engineer
higher. You know, we baby watch your impulse, right? Yes, impulse in the base, a higher low, right? Look at the first one.
I mean, you see this English. For you to identify an uptrend, you must see series of higher highs and higher lows.
So a new high exceeds the previous high.
Exactly. A new high exceeds the previous high. A new high exceeds the previous high. A new high exceeds the previous high. That is a higher high. This is a higher high. Cause highway a watching way. Not at twice higher high. Highway a watching way. Now lower low. That means higher low. That means low way. This low is higher than this low.
Yes.
This low is higher than this low. So we have it called higher low. What I say? Steps be take piano. We make sure say that step is higher than the previous one. and a low so so that low is higher than the previous low. It creates a series of higher highs and higher lows. Now I have it many things on the chart. I say first of all, to identify an uptrend, you want to see price creating series of higher highs and higher lows. Higher highs and higher lows, we call the high swing high and the low swing low. Now, this is an impulse. Impulse has to break a higher high. Impulse has to break a higher high. And when a correction is forming, this correction is not supposed to come and then take this swing low or this higher low. What you say, Visa? And I be brave so.
Okay, so for Matthias, and Stefan say a new correction. Maybe yesterday marketing you say, oh, whether to decide whether it's uptrend or downtrend. And you say for 2 times, you say trending echo up. So on the third time, if the new correction comes to break the high low, the previous high low, and give it was why back trend, now I confirm say uptrend, it be breaking it, meaning say it's no longer
exactly
a high uptrend.
Yes, exactly.
Okay.
It's so simple.
Okay.
See, this is an uptrend, and same thing for a downtrend. Mami inverse chart, downtrend is ube say ya. Let's say downtrend ebe create impulse, correction, impulse, correction. But here the only thing that will change is it creates a series of lower highs and lower lows.
Okay.
I mean a new one. In percent when it complicated. So downtrend now say who be say. Series of lower high, lower low, lower high, lower low, lower high, lower low. Now, the only thing that differentiates an uptrend and a downtrend is for a downtrend, price break, swing lows. I say a bit fair swing lows. Swing lows. Where we have this is called swing high. Swing high. Swing high. Way a strategy. So when you have market structures here, you are 80% done.
Do I necessarily need a desktop?
Not really, but if you get it, it's a plus. Like not really, but chat in if you have the means, you can. But if you don't have the means, don't stress yourself. So for a downtrend, we want to see a series of lower highs and lower lows. So we call here also. I don't want to make this one too much. The demarcation is too much. Lower low, lower low. Lower, lower, low. Lower, high. Lower, high. Lower, high. Okay, so for a downtrend, you want to see price take out lower lows and lower high. The swing lows is called lower lows, and the swing high is also called lower high and lower high, lower high. The reason is this high has to be lower than this high, and this high has to be lower than this high. What you say? The low is lower high, lower high, lower high, lower high, and then lower low, lower low. So it is more like the previous swing high, has to be above the next swing high that will form to give us a lower high. So the inverse of the higher highs, higher lows is the same as lower highs, lower lows. Just that I know you label her lower because price for me lows but from trending down. So high lower high lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. That is a downtrend. And we have the impulse. Here is also known as impulse. The bigger move is called impulse. Same for the uptrend, impulse. Pulse. Now this pullback, this is called correction. This is called correction. Correction. Yeah. So for a downtrend, price break swing lows, not swing highs. You say I say your friend has say swing high. I know the swing high waha, the swing high waha, cause a cost and I know the swing high waha, the swing high waha, the swing high waha. For a downtrend, price breaks swing lows, and now we're in swing lows waha. So for a downtrend, price. We started from market structure. We said market structure is the behavior of the market, is the behavior, condition, and current flow of the market. So we got to know the two kinds of market structure. We said we have trending market and ranging market, and under the trending market we have what we call uptrend and downtrend. Uptrend is also known as bullish market. Downtrend is also known as bearish market. So it is bullish and bearish. So ranging market is in a situation where the market will be moving sideways, and then uptrend is a situation where the market will be creating series of higher highs and higher lows, and downtrend is a condition of the market where the market will be creating series of lower highs and lower lows. So that is the kinds of market structure and its explanation. Now this is the chart's explanation. You can see here price was going up, creating series of higher high. This is higher low, higher high, 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 higher low. So if you see anything like this, your focus should be at the swing side. The swing side is an impulse breaking the previous highs. This was a previous high, it got broken. Previous high got broken, and whenever it gets broken, the pullback or the correctional move don't come and break the last low. So in that sense, we call it uptrend because we're having higher high, higher low, HL, HL. That is an uptrend. It's when market is making series of higher highs and higher lows. That is an uptrend. Now, a downtrend. A downtrend is when market is making series of lower, low. No, it's supposed to be lower highs and lower lows. Lower highs. Yeah, so a downtrend is when the market is making series of lower highs and lower lows. For this image, we have what we call a lower high, a lower low, a lower high, a lower low. Our focus is to see price break the lower lows. If price gives us a consecutive break of lower lows, then it is a downtrend. So we're having lower high, lower low, lower high, lower low, and any correctional move is not supposed to come and take the lower high. You can see with the skeletal structure, we have LL, LH, LL, LH, LL, LH. So it is creating series of lower highs and lower lows. That is a downtrend. And in a downtrend, what we do is we buy, we sell. When you come and meet a downtrend, you always want to look for sell opportunities. Yeah, sell opportunities. We sell when price gives a pullback, and then we take this move to the downside and we make profit. But for an uptrend, what you do is you buy. So you look for buy opportunities. So if price provide an impulse move, gives correctional move, then you buy from the correctional move and then take price to go and break the swing high or the higher high. Yeah, so we buy in an uptrend and then we sell in a downtrend. Now, for a range market, is when price is consolidating from one point to another that is not really making any trend. It creates highs and lows. Avoid this market condition as a beginner. So if you're a beginner and you see price going sideways and you can't understand the trend, you will not get how structure is being presented, then you have to exit or you don't have to take any trade with a ranging market. But for me, I will know that this is a high price created, a low price has created, and now coming back again, it will definitely respect that zone to create another high. So then I'll sell from here and then take it to here. But for a beginner, it might be difficult. Yeah. So for a range market, if you're a beginner, it is not advisable to trade a range market. So price goes sideways. Yeah. So that is the forms of market structure and the various explanations to them. Now, buy or sell. Going long, which is buy, expecting price to go up. As I said earlier on, if you're expecting price to push up, what you do is you buy, and it's the same as going long or
Mm.
bullishing. If you hear bullishing, it is the same as buying or going long. Example:
Oh,
buying euro USD means you think the euro will rise against the dollar. So you see, we have two pairs, and we said earlier that the first pair is what, base currency, and the second
yes.
is cold currency.
It's good.
Yeah. So if you say I'm going long on euro USD, that means you are expecting euro to appreciate or go up, or bullish against US dollar. You get it?
Yes, sir.
Yeah. And going short or sell means expecting price to go down. You get it? So the opposite for going long is going short. And short is also known as sell, and sell is also known as bearish. Yeah. So this is the concept. These two animals. We have bull and then bear. They are animals. They, they,
Yes.
they gave the name, um they use those animals name to represent this market. Because for a bull, if a bull is striking you, it strike you to the top, it strike you up. And a bear, if
Mm.
a bear is striking you with the horn, it strike you to down, yeah. So that is how come they got that, they deduce the name for this market. So they use those animals, bulls and bears, to generate the name for this market. Yeah. So the market is called bull and bear market, bullish and bear market. Yeah.
Mm.
Bulls and bears. So whenever you see, I have the image here.
Yes.
This is a bull, it will strike you
Mm.
up. This is a bear, it will strike you down.
Good.
So those are the two animals. So if price is going up, we are bullish. If price is coming down, we are bearish. Types of forex traders. We want to know the various types of forex traders. One is position trader. Two is swing traders. Three is day traders. Four is scalpers. So we have four main forms of forex traders, or traders basically. So we have position traders, swing traders, day traders, and scalpers. Now, position traders hold trades for weeks, months, and they target about 500 to 1,000 pips. Usually they use daily time frame. So we also talk about time frames when I'm introducing you to trading view. We talk about time frames. So position traders, they hold trade for a very long time. Um, they can buy for today and then close their position maybe next month or next 2 months or even a year. So they hold trade for a very long time. And swing traders, they are like medium term, like they can hold trades for days, targeting 50 to 150 pips. They use daily, 4 hours, and 1 hour chart to make their projections. So they can hold trade for week and a month, but then position traders actually hold trade for a very long time. Yeah. And day traders, they are short term traders, open and close trades in a day, targeting 20 to 40 pips. Use 4 hour chart, 1 hour chart, and 15 minutes. So the traders expect to take their profits within a day. They take Whenever they execute a trade, they make sure they close the trade within a day. Yeah. Now scalpers, so they are ultra short term, trade within seconds and minutes. If like this morning I want to trade and get some quick money, I will just go to the chart and then scalp.
Okay.
They are very short term traders. They just want a short move. Let's say I want to sell from here. I want to sell from here and then
Mm.
take my profit here. It will be a scalp trade, and put my stop loss here.
Okay.
It's a scalp trade because I'm expecting price, and it is 3 minutes time frame. I'm expecting price to just drop here and then go out from the market. But if I'm swinging or day trading, I would expect price to give me some crazy pips, like more moves to the upside. Yeah.
Mm.
So that is scalping, and then day trading, and swing trading, and then lastly um, position trading. So position trader would buy here. Let's say this market, I am to be a position trader. I will buy at this low and be holding. I wouldn't close my trade and be holding it. And this one
Mm.
is more than let me see. Yeah, 16th January, and then today is 29th. So it
Mm.
will be more like holding this trade for 2 weeks or 3 weeks for a
Yes.
position trader. But a day trader
Okay.
or a swing trader, this is a day trading. You buy and then you close your profit. You look for opportunity. You sell. You close your profit. You buy. You close your profit, and it goes like that. For a scalper, it's just few minutes and then you are out of the market. But I will always recommend day trading and swing trading.
Okay.
Day trading and swing trading. Scalping is very risky, and if you don't take care, you can take more than 10 trades in a day, and it can wipe your money very fast. So let's proceed. So each trading style demands different level of patience, discipline, and risk management. The key to success in forex is choosing a style that matches your personality, lifestyle, and time availability. So if you are someone who is always busy with having a whole lot of duties to perform, then scalping is not something that you can do. You can only day trade, you can swing trade, and then position trade. Yeah, but if you are someone who has free time and you always available and you have a strategy that works for scalping, then you can be using scalping to trade. I mean, you can be trading within a day or minutes and expect returns. So these are the forms of forex traders. Position traders, they hold trade for months and years. Swing traders, they hold trades within weeks, within a week, or even can be within weeks. Let me put it that way. And day traders, short term, they expect to take profits within a day or 2 days. Maximum days that a day trader can hold trade is a week. Maximum time frame that a day trader can hold trade is a week. And scalpers, they expect profits in a minute or um,
Shortest possible time.
exactly ultra short term. So now let's talk about candlestick anatomy. What you see on the chart here, we call them candlestick. These are all candlesticks. So we have bearish. The black one is bearish candlestick. You see it is coming down, so we call it bearish, right? And
Yes.
it is a bearish candlestick. And the blue one, the sea blue one, is called bullish candlestick because it is going up. So let's do the breakdown of the various candlesticks. Now,
Okay.
candlestick anatomy. What is a candlestick? Japanese candlesticks are formed using the open, high, low, and close of the chosen time frame. So labeling the parts of the various candlesticks, we saying there are some how do I call it? There are some features it is having. So the one of the feature is price opened at this high. This side is called open. This high is called open, and this high, the wick side is called high, and the low here is called close, and then the low here is called low. I mean the wick here is called low. So we are trying to label the parts of the various candlestick. So here is called body, the full side where the shaded portion is the body. So real body of the candlestick, the upper shadow of the candlestick, the lower shadow. It is also this thin line here is called wick. This thin line is called wick, and this guy, the body side, is called real body or body of the candlestick, and the side here is called upper shadow or wick. So let me show you on the row chart. Now we are focusing on this particular candlestick, this one. You see,
Okay.
we have the body here. This is called body. This is called body. Body of the candlestick. And then the thin line over here is called wick. Wick or shadow, but I always prefer wick. Wick. And then price closed here, the closing part. Let me. Alright, so this was the lower side of the candlestick, so we call here low of the candlestick. Even though this is wick, this low is called wick. That's the main term for it. We have a wick below here and a wick above here. So the downside wick is called low. Let me show you. This is low. This is low. Yeah. And then the high wick will be called high. Now the reason is when new candlestick was generating, it came down here and then went up here, then finally came to close here to form this bearish candlestick. Now we will get to know how bearish candlesticks form and bullish candlestick how they form. Now let me go to the row chart and do the labeling. So we call here low and then wick, and then here is the high of the wick. High of the wick. Our main focus is on this candlestick or this sea blue candlestick.
Yes, sir.
Okay, and then for a bullish candlestick, this is how it forms. Price actually opened here. It opened here when it was forming. You see now this is a bearish candlestick forming. It actually opened at the top here, and then if it closes, it will close below to form a bearish candlestick. But now for a bullish candlestick, price opened this low, Because bullish is always, we are expecting price to go up, it has to open
Okay.
at a lower point and then flip over to the upside. So the opening of the candlestick was here, and then the closing, price closed here, and the close happened here. So this is how, now you see new bearish candlestick formed, and now new one is about to form over here. You see that? You see, if it is able to drop down, it will form a bearish candlestick. If it is able to go up, it will form a bullish candlestick. And we said a bearish candlestick, we want to see price come down, and a bullish candlestick, we want to see price go up. Yeah, so that is a bullish candlestick, how it is formed. Now let's look for a bearish candlestick and label it. Let's use this one. Let's use this one. So this candlestick opened at the top here. You see the wick was very small and the body was very big. So it opened at the top here. So open, and then came to close here, close. And this is the body, this is the body, this is the body. This is the body, and then the wicks are the ones at the very end. They are very small, so I will not pay much attention to it. So what else? Let me look at it.
I think that is that.
Yeah, that is all. That is all. Now, one thing you should bear in mind is for the color of the various candlestick, it doesn't matter. You can have this color to be green or any color that you want to, but the only thing that you have to pay attention to is where the candlestick closed and where it opened. I can have all these candlestick same color. I can have black and black and black for bullish, black for bearish. But for me to know whether this is bullish or bearish, I have to be able to understand where market closed. I mean, the candlestick, various candlestick closed and opened. If it closed below here, that means it actually opened at the top here and then flipped over to down here to come and close. That was how we got a bearish candlestick. If it opened beneath here and then it closed above here, then it should tell me that that is a bullish candlestick. Yeah. So these are the various types of candlestick and how the various parts of the candlestick. Yeah, that is it. Now, two kinds of candlestick. We have bearish candlestick and bullish candlestick, and I think all these are English, and I think I have explained it. I'll just read. If the close is below the open, if the close is below the open, this is the open. If the close is below it, and now it is below it, we can say that the candlestick is bearish, which means that the market price is falling. So if the close is below the open, then it is a bearish candlestick, and this is a bearish candlestick. If the close is above the open, we can say that the candlestick is bullish, which means that the market price is rising. So for this one, open over here and the close above here, so it is bullish. If the close is above the open, this is the close above the open, so it is bullish. It means that the market price is rising. This filled part of the candlestick is called the body. This one is the body. The thin lines poking above and below the body are called the upper and lower shadow or wick. Yeah, upper and lower shadow. This is the poking lines, the poking thin lines. So the top of the candle, the top of the upper shadow is the high. This is the high, and the bottom of the lower candle is the low. This is the low. So those are the various explanations. Now we now understand market structure. We now understand candlestick anatomy. So I will give you a quick review on market structure so that you wouldn't forget. Let me clear the chart again. Yeah, so market structure, we said we have is the behavior and condition of the flow of the market. So we're saying that if price is trending up, it is a bullish market, creating series of higher highs, higher lows, higher highs, higher lows, is a bullish market. And if price is trending down, creating series of lower highs and lower lows, is a bearish market. And if price is going sideways, it's a ranging market. So this is how the market moves. And if you want to make money, you must understand, it's a must to understand this, else you'll be at the worst side of the market and it will really punish you. And we can see that this market is a bullish market. Price taking swing highs, breaking this high with this impulse leg, and then if price is creating higher highs and higher lows, we said it's an uptrend. If price is creating series of lower highs and lower lows, we said it's a downtrend. Now If price is going sideways, we said it is a range. So these are the various forms of market structure, and then your ability to identify them on a chart will determine your profitability. If you will make money or you will not make money. That is what will really determine whether you make money or you lose money. Yeah. So these are the various forms, and it gives us an edge to know where price is going and to know the decision to take. It is very, very important. Without it, you can't predict the market. Without it, you can't predict the market. So those are the various forms of market structure. And then for an uptrend, we said we want to see price break highs and lows, break highs, and then being unable to break lows. See, with this, we have what? A breakout structure with an impulse move here, and then give us a correctional move, and then give us impulse move again. So it is breaking structures to the upside. So if you are a trader, what you will do is you position yourself. You will be waiting for corrections to look for buy continuation. You see, when price took out this high, it came down, and if you know, there are some things that you must know. If you get to know them, you know where to buy and where to sell. The price came here, and then you take your buy to the upside, and price took out this high again, so we have a break of structure again. Now after the break of structure, price came down again to this low, and then you buy again. You look for buys again. Look for buy again. Now we have a break of structure. A break of structure over here. What you do is you wait for price to come down, but then price momentum or the bullish momentum was very high, so it went up and never came down. But definitely price will come back, and then you look for buy opportunities over here. You look for a buy opportunity when price come down. Now it went ahead to take swing highs. This was a swing high. Took it, and then you wait for an opportunity to keep buying. So whenever a high is taken, expect correction. Like whenever an impulse break a swing high to create a higher high, expect a pullback to take a buy opportunity, to take a buy trade. So we had a break of structure over here. Now this one was too small. Check something. Let's proceed. Now we took out this high. This high was taken, and then price came down to take the low over here and started buying. So the market will not give you a perfect picture, but you have to understand your swings. You have to know your swing sides. Yeah, it's very necessary. You have to know the various swing side of the market, and then take advantage. For uptrend, you always want to focus price. You always want to focus on the swing highs, that price is breaking it or not. Yeah. And for a downtrend, you focus on the swing lows, that price is breaking the swing lows or not. That is very necessary. Let me look for a bearish market. Alright. Let me clear everything. So you see, the trend that we are having here is bearish trend. Price is breaking lows. This was what? A low that price took. So a break of structure. This is a break of structure.
Okay, so hello. Let me get some.
I'm listening.
So when yes, the first point that you marked, that's the low, right?
This is the low.
So price went on and price came up to surpass that level.
Exactly.
And then when it surpasses that level, you can anticipate that price will drop again.
Exactly.
To create the bearish trend.
Yeah, exactly.
So the next point that you are going to probably look out to buy to sell again
Yeah.
is that
a
the
pullback.
new low that the new low that it will create. You anticipate that price will come up to surpass that level again, and then you can anticipate that price will drop again.
Exactly.
Okay. Okay.
So that is how we trade.
Okay.
That is how we trade.
Okay.
When you see price taking out lows, this is series of lower lows, lower lows, lower
Mm,
high, lower lows, lower highs, lower lows, lower highs, and then lower
yes.
lows. And now we have what? A lower high. What do we expect again? A lower low.
It-
So
Yes.
if you
So over
were,
here, it and so
yeah, and you wait and then you sell.
let's say when you go to the lower high, you know that the next thing is for it to drop. So you sell over there and you wait.
Yeah, exactly. Exactly. So it is very simple if you can identify them, nothing complex. It is very, very simple if you have the ability to see and then
Okay. I think
very, very
I'm now understanding it.
yeah. So I actually said for the theory it will look very crazy, but then if you get to the practical aspect, it is very easy. So if this trade, I took this trade, I know there is a break of structure over here, and this is the swing, the impulse move. This is the impulse, and this whole move is correction. And then we're now looking for another impulse. You get it? Yeah.
Yes.
So that is how the market moves.
Okay. Please, which time frame are you using right now?
Oh, so you understand time frame? When you remember,
Uh,
this is 45 minutes.
okay. So so that's I want to get the patience part because I've realized that. So the book that I read, okay. And the day that we had our first session, I went to YouTube to watch some videos to help understand, help me
Yeah,
understand.
very
So
easy.
right now it means that right now the 45 minutes, it means every candle represents 45 minutes.
Exactly.
So that means that you have to really, really wait, like hold the position for some time before you
Yeah,
can
bro.
make.
Yeah, so this move actually happened. This buy move actually happened. When let me check. You see the date is here. Sunday. Yeah, 25th. Yeah, and then it went up here. Now just yesterday, and price started dropping from here. Yeah. So
Okay.
in case you miss this trade, you can wait for another opportunity to look for sales. Right?
Okay.
It is not difficult like that. It is not difficult like that.
You are now, I mean, opening things like the practical is really, really helping.
Yeah.
I'm not understanding the structure, like the whole candle movement and all of that.
So this, as you said, every single candlestick, it depending on the time frame that you go, every single candlestick, the closure of every single candlestick depends on the time frame you are in. So if if now new candlestick is forming, that means it took this particular candlestick 45 minutes to close.
Yes.
And then if new one is forming, and let's say you go to 1 minute, there is 1 minute time frame candlestick. It also means it will take 1 minute for those candlestick to also close. Yeah, so it is very, very easy and nothing complex. So market structure, we are saying if price is taking out lows, this is a break of structure. Now let me represent it with a boss, BOS, a boss. A break of structure over here, a break of structure over here, another break of structure over here. Now we have break of structures to the downside. Now this is the swing side of this current break of structure. So we call all this move, we call all this correctional move. And now an impulse move is happening. So it will be trending down, and if this low gets taken out, if this low gets taken out, a new break of structure will occur here. A new break of structure will occur here. And now here will become your new point of interest or zone to look for sells. So if it breaks like this, you have to wait for this to happen, and then you sell again.
Okay.
So that is the behavior and the pattern of the market. If you understand it, it will be very, very helpful to always know where price is going. So you take a decision that goes in line with the trend. So we always trade in line with the trend. We don't trade against the trend unless you are scalping or you expect some quick returns. Yeah. So you see now price is trending down, and if you want to join the sell, you just have to wait for this low to get taken out. This was the ideal zone to look for the sell.
Okay.
This was the zone to look for the sell.
But if you missed it,
you missed it. So you'll be holding this trade till your target's hit. Maybe you'll be targeting here.
Mm.
You'll be holding this trade till your target gets hit.
Okay.
Yeah, so that is it. Now, um, if you see this low get taken out, I have actually said this, but I'm just repeating it. If this low gets taken out, then trend will continue. Then it becomes a downtrend because price is
Mm.
in a series of lower lows and lower highs, creating lower high, lower lows, lower highs, lower lows, lower highs, lower lows, and it goes like that. The moment you see a trend is changing, then this high, if this high gets taken out, let's say
Mhm.
this low, this price drop like this, and instead of respecting here, it went ahead to take out here. Now there is what we call change in trend or market structure shift.
Okay.
Yeah, so that means there is a shift in structure from bearish to bullish because the pattern that market is using to approach the upside, it has changed from bullish,
Yes.
from bearish to bullish. So then you look for, now your bias for sales will change to bullish. It is very simple. If you can
All right.
identify them, it is very, very simple. Now we still focusing on the strategy, and then we will talk about the range. Range is
Okay.
when price is going sideways. So over here we can see market is going sideways. Market was
Mm.
going sideways. So with this, if you are not an expert, you just have to um,
Okay.
um, exit or don't take any trade in this market. But for me, I can see before price was creating lower lows over here. This was a low because price took this low,
Mm.
and then a low. So series of lower lows, lower highs, lower lows, lower highs, lower lows. And getting to know that this was the last high price created and the price came down, came up to take it. I know there is a change in structure, or there is what we call
Mm.
market structure shift. So I will then change my bias from looking for sells and then move to buys. Yeah. So then I will look for my liquidity and pick my entry from this downside and then take a buy and be holding it till there is something that we call trend line liquidity. Urgent action required. There is something that we call trend line liquidity. I'll wait for price to clear that trend line liquidity and then I'll buy. So I think for now we are done with the basics. All that we will be doing is more practice, more of the advanced session, and then you get to know the strategy to use to trade. But I will run you through how to take a buy, how to take a sell, and you will get everything. And the orders, yeah, that is the orders. Those limit orders. It will make you, I'll run you through everything. So I think that let me look at the slide and see the next thing.